The trustee of an SMSF makes all fund decisions and holds ownership of all fund investments. An SMSF can have either individual trustees or a company as the trustee of the fund. Generally, all individual trustees or all directors of the corporate trustee must be fund members, though there are exceptions. 6 is the maximum number of members, but some states and territories don't allow more than 4 individual trustees, so if the SMSF has 6 members, this discussion is probably unnecessary as a corporate trustee will probably be required. This is seldom the case though, as most SMSFs don't have more than 4 members. Most actually have either 1 or 2. So which type of trustee suits best? Costs are cheaper for individual trustees as there is no need to establish a company. Neither is there a need to pay yearly ASIC or secretarial fees. Costs will vary depending on supplier, of course, but you can expect a corporation to cost under $800 to establish and under $200 per annum to operate, including ASIC fees, which are discounted for a company that is only acting as an SMSF trustee. So why choose the more expensive company trustee anyhow? A single member fund must have 2 individual trustees. That's the member plus one other person who is willing to be a trustee and not a member. The corporate trustee of a single member SMSF can also have 2 directors, where only one is a member, but it can have only one director if preferred. This means the single member can be the sole director of the company and have total control over all fund activities with a corporate trustee. Ownership of fund assets must be recorded in the name of all trustees on behalf of the fund. For individual trustees, every trustee's name must be listed. So, if a member leaves or joins the SMSF, ownership details must be changed for every investment. Registering such changes may be difficult, expensive, or in some cases, impossible. Some assets, such as life insurance policies, may require cancelling and rewriting, which is problematic. Ownership changes may also be required at particularly stressful times if, for example, the change is due to the death of a member or breakdown of a relationship. For a corporate trustee, only the company name is listed, so even if there is a change in SMSF members or directors, the investment ownership does not change. The ATO's penalty regime is applied quite differently to each trustee type. The most serious administration penalty is approximately $20,000. It's payable personally by individual trustees or personally by the directors of the corporate trustee, but the amount payable is quite different. Where trustees are individuals, the penalty is applied fully to each trustee. For corporate trustees, a single penalty is applied to the group of directors. So, in a 6-member fund, individual trustees would be liable for around $120,000, whilst directors of a corporate trustee would, collectively, owe $20,000. If a corporate trustee is preferred, then there are a few structural details that should be considered. Trustee voting power may be an important consideration. Most SMSF deeds provide 1 vote for each individual trustee with a tie-breaking vote for the chairman. Some SMSF deeds link a trustee's voting power to their fund balance. This may be preferred in a situation where a parent with a significant balance is joined in the fund by 2 children with minor balances, and the parent wants to ensure they're not outvoted. The voting powers of a corporate trustee override those stated in the deed, so if special voting powers are required, be sure to include them in the constitution of the corporate trustee as well. Even though SMSF members are required to be directors of the corporate trustee, there are no restrictions on who can be shareholders. As the company shareholders ultimately dictate who can act as directors, including additions and replacements, care should be given to selecting both the shareholders, usually the fund members but not necessarily, and the number of shares held. The shares have no real value except the control they provide to the shareholder, so might be relevant in an estate planning or relationship breakdown. Note that, though a shareholder does not technically need to be a member or director, certain financial institutions may require they be included in the ownership details for an investment, which could inadvertently breach superannuation law. Advice should be sought. Sometimes members who are already directors of an existing trading company or a company that is acting as trustee for a family trust may consider using that company to be trustee of their SMSF as well. The cost savings are minor, but the problems this might create are not. The directors of the company will need to match the fund members, which may not be appropriate, particularly for a trading company. The correct ownership of investments and the SMSF's cash account might become more difficult to identify, leading to mistakes that could result in significant ATO administrative penalties. Sometimes, just because you can do something doesn't mean you should. We hope that you found this information useful. For further clarification, you should speak with your financial advisor.